Ben, what did I agree I had to name my son if you showed up to the podcast today?
We're going to get a Yoshinobu Yamamoto Gustafson.
Can't wait to meet my boy Yoshi. I said that to my wife and she goes, not gonna lie, kind of better than Carl.
What I found fascinating, so these companies, these outliers, they increase their average revenue per account by 82% on the path from 1 to 20 million ARR.
How many times can this guy write about net dollar retention?
The limit does not exist. You're out here with the big terms, CJ. Can you spell that?
Yeah, sometimes I read the dictionary before I go to bed. Well, speaking of big words, have you heard of the Herfindahl-Hirschman index?
I feel like you just made that up. What is this?
No. Do you know what an embargo is, Kyle?
I mean, I worked in marketing, so I do know what embargo was, but do you know what an embargo is probably the better question.
I thought it was like a French restaurant or something.
From Mostly Media, it's Mostly Growth. Go-to-market strategist Kyle Poyar and CFO CJ Gustafson share smart takes on growing revenue and running a company. Pricing, unit economics, AI, leadership, candid insights for CEOs, CFOs, and CROs, or anyone else aspiring to climb to the C-suite. This is Mostly Growth.
Hey, thanks for listening. We'll be right back after a word from our sponsors. As a CFO, you're expected to bring clarity to everything, including how your company manages ownership. The tools you use should make that easier, not harder. But when they come with hidden fees, data you can't always trust, and support you can't rely on, you end up with more frustration than clarity. That's where Pulley comes in. Pulley is a cap table management platform built for finance leaders who need accurate, decision-ready data from a system that works for your business, not against it. With Pulley, you get intuitive workflows, audit-ready reporting, and support you can count on, all backed by predictable pricing you can plan around, so you can stay compliant and make smarter decisions about your company's future. Manage everything from fundraise modeling to ASC 718 reporting to custom liquidity programs, all on one trusted platform. Hundreds of high-growth companies like Linear, Fathom, and Runway trust Pulley to help turn ownership into a strategic advantage. And joining them is now easier than ever. You can switch to Pulley in as little as 5 days. And for a limited time, they're offering 25% off your first year. To claim your exclusive offer, visit pulley.com/mostlymetrics. That is PULLEY.com/mostlymetrics. Please, guys, I really need this. Pulley.com/mostlymetrics. You just launched a new AI product. The new pricing page looks great. I'm talking crisp. But behind it, last-minute glued code, messy spreadsheets, and running ad hoc queries to figure out what to bill. Customers get invoices they can't understand. Engineers are chasing billing bugs. Finance can't close the books. Well, with Metronome, you hand it all off to the real-time billing infrastructure that just works. Reliable, flexible, and built to grow with you. They turn raw usage events into accurate invoices, give customers bills they actually understand, and keep every team in sync in real time. Whether you're launching usage-based pricing, managing enterprise contracts, or rolling out new AI services, Metronome does the heavy lifting so you can focus on your product, not your billing. That's why some of the fastest growing companies in the world like OpenAI and Anthropic run their billing on Metronome. Visit metronome.com to learn more. That's metronome.com. Welcome back to the Mostly Growth podcast. Ben, I'm glad you're here with us today. I know you could be out gallivanting, watching your LA Dodgers do parade things.
I know.
But I appreciate it.
Yeah, of course. You know, I mean, they'll probably be back a couple more times in the next few years, so I'll have some more chances, I'm sure.
We were texting back and forth last night. And Ben, what did I agree I had to name my son if you showed up to the podcast today?
We're going to get a Yoshinobu Yamamoto Gustafson in January.
Can't wait to meet my boy Yoshi. I said that to my wife and she goes, not gonna lie, kind of better than Carl.
We actually did that. My girlfriend's sister's having a baby today, and they were watching the game with us on Saturday, and we were just going down, all right, whoever the hero is, that's going to be the name of the baby. So Yoshinobu Yamamoto, I guess that's going to be a popular name.
Wait, I'm like blanket. Is Yoshi also the character from like Super Mario?
Yeah.
Love it. You've got to name your kid that, CJ.
Yoshi Gustafson.
It's a big debate in the house.
It has a good ring to it.
Carl, and so I want to name him Carl, but call him Trey. And my wife hates that. And we just found out that the neighbor next door, their son, his name is Michael, but everybody calls him Trip. So I'm like, come on, just pick between Trey and Tripp. And she hates both of them. So I think I got a better chance of having the same name as the Dodgers closing pitcher.
So I had a fun segment idea for you, CJ.
Okay.
So before we learned you don't know who Beyonce is, paraphrasing.
I know who Beyonce is, guys.
I mean, do you though? So I had an idea where I'm going to give you 10 names of people.
Okay.
And you have to tell me, is it a SaaS founder or is it a pop star? And you have to, give me a rapid fire answer. You can't be Googling this.
Okay.
Also, if you think it's a SaaS founder, you'll get a bonus point if you can guess what company they're from.
Is it like their government name or are you going to say like Post Malone?
Not the government name, like the stage name they use.
Okay. All right. I'm ready. I'm gassed up.
Should we make this more interesting?
Sure.
If you can get 10 points, which would be hard, but not impossible because you get double, right, for guessing both that they're a founder and what company.
Okay.
You get 10 points or more, I'll Venmo you $50.
Deal.
All right, first up, Patrick Collison.
That's a SaaS founder. Stripe.
Ed Sheeran.
That's a singer.
Sam Feld.
Ooh. I'm cheating.
Could be a folk singer from Vermont, but I'm going to go with SaaS founder.
Melanie Perkins.
Founder from Canva.
Guillermo Rauch.
Founder from Vercel.
Renee Rapp.
Pop star?
Elena Verna.
Esteemed newsletter writer.
John Mayer.
Ugh. So funny story. John Mayer is from Fairfield, Connecticut, where I am right now. And my neighbor said that John Mayer used to work at the Cumberland Farms down the street and he'd buy cigarettes from him.
And which tech company does he work for? John Mayer?
Boeing.
Zeb Evans.
Zeb. Well, what's the name?
Zeb Evans.
That's got to be a founder.
And then Sabrina Carpenter.
HubSpot CMO.
All right, you got 8 out of 10. Sam Felt, he's a famous DJ. And
Is he really?
Sabrina, I think you were just phoning it in because you knew you were going to get your $50. You did a better job than I thought you were going to do.
You don't have to pay me. Just buy Ben a World Series t-shirt.
So first up, we've got our growth levers report. Which ones are you guys going to pull? I want to know.
All right. So I have been partnering with a company called ChartMogul. They have data on 6,500 companies. I don't know if listeners remember from before, but one of the things I looked at was what are the odds of a SaaS company getting from initial monetization to 20 or 25 million ARR in 10 years. And turns out that it's harder to get to 20 million ARR than it is to get into Harvard or Stanford. Just 3.5% of companies do it in 10 years. And so I now wanted to look at what separates those companies, those 3.5%. What makes them different than everyone else who doesn't make it? And CJ, any guesses of what separates those two?
Well, my initial hunch was their ability to upsell and cross-sell their customers. So expansion, acquire the customer once and get more from them over time.
Not a bad guess. So expansion, at what point? Like just the business model is built for expansion or expansion gets better later on?
I think that the business model has to be built for expansion because I do think that companies go deep into the red trying to add another module when it's not like a natural attach rate motion. So if it's a usage-based company, I would think that that lends itself to automatic expansion without having to add a new product.
I had a similar hypothesis going in. I mean, I used to work at a VC for a while, right? One of the things that we would look at was net dollar retention, thinking that, if it was that best in class 120, maybe 150%, these were companies that were just going to keep growing because they could compound year after year. Turns out the net retention rate for the companies that made it to 20 million and those that got stuck at, around a million or two, the net retention is actually not that different. They were pretty consistent at 1 million ARR. What happened though is that the 20 million companies, I call them the outliers in the report, they didn't start better, but they got better over time. So as they scaled from 1 to 20 million ARR, the majority of them were actually able to improve net retention. And in many cases, actually improve that number like pretty substantially. And so the average, I'll bring up the stats specifically, but the average company here, 51% of companies in this study improved their gross revenue retention rate by more than 10 points. At 45% improved net revenue retention by more than 10 points, specifically of these outliers. So the median company in the data set had an 83% net revenue retention when they were at a million ARR, and they were able to improve it to 93% by the time they were at 20 million ARR. So that's a pretty meaningful acceleration in net revenue retention. Though companies that didn't make it, they were not able to move the needle on that metric.
Do you know what FITFO stands for?
I have no idea.
Figure it the fuck out. So I think a lot of companies that at 1 million in ARR are still FITFO. They're still trying to figure it out. And so many of the customers in that base may not even be in their ICP of what they deem to be core at 10 or 20 million. That's all that I push back on.
I think there's a lot of that in the data set. I mean, we talked before about a YC, the kind of magic YC formula, and how you want to get to 10K MRR with $100 average, monthly spend per customer, even though it's actually pretty hard to build a great business around $100 per month customer. And you have a lot of high churn in that business model. What I found fascinating, so these companies, these outliers, they increase their average revenue per account by 82% on the path from 1 to 20 million ARR. They improved net revenue retention by about 10 points, gross revenue retention as well. And expansion as a share of their net new MRR went from 15% up to 35% by the time they were at 20 million ARR. And so you're kind of like totally re-engineering the company on this path. And you kind of have to take what you were doing and throw it out and build a new company.
So as a finance guy, I know that to get to 100% year-on-year growth, 6% month over month, if it's 12 months sequentially, it compounds to about 100%. And what I really liked about this piece, Kyle, is you broke out not just the annual growth rate, but the monthly growth rates. And it brings us back to a couple episodes ago where we were saying it seems more attainable to hit this lofty goal if you bite it into these smaller portions of saying, listen, this month we need to grow 16% month over month, rather than saying, I don't even know what that compounds to, like 350%.
For context for listeners too, so the average company that became an outlier, they were growing at about 17% month over month when they were at $1 million ARR, which is quite fast at that point. And then they were growing at 5% month over month when they were at 20 million ARR. So still quick, but based on CJ's quick math here, it's under the 100% year on year. And there's a steep growth deceleration that happens as you scale on a percentage basis, even if the absolute numbers of net new ARR you're adding gets bigger over time.
So just to put a bow and a ribbon on it, Kyle, which number surprised you the most, or you felt like validated what you already knew?
I thought the net revenue retention number surprised me a lot because I thought of that as a very hard metric to change. It feels like one of those things that's kind of set in stone, like it is in your DNA, but the companies that are great are just able to, I think, go after a better customer over time that's in their ICP that retains at a higher rate. They're great at launching new products. So there used to be rule of thumb that you don't launch a new product until you're a category leader and you're, 50 million plus ARR. Well, now more and more, I think the expectation is to launch new stuff frequently and to ideally be launching things that aren't just, new features, but they're things that are valuable enough that people are willing to pay for them. So the net revenue retention figure was cool to me. I think the other thing is just pricing went up substantially. So the folks that hit 20 million ARR were able to increase their average revenue per customer by more than 80% on that journey. And, that's a combination of selling more stuff, but also price increases. And, it's not something that is always the favorite lever to pull. It can be a painful lever, but it's worth a lot of money.
As pricing expert Fat Joe would say, yesterday's price is not today's price.
That is your favorite quote. One other bonus takeaway for folks in this that are listening to this and wanting to check out the full report here. So the companies that became outliers, they were growing a lot faster than their peers at $1 million ARR, but the top quartile companies that didn't make it were growing faster than the median company that did make it. So that's a long-winded way of saying starting growth rate did matter, but there was a lot of companies that were growing quickly that never made it to 20 million ARR. And there were companies that weren't growing quickly at $1 million that got there. And so it's not necessarily about what your business looks like at $1 million. It's what changes you're going to make to get better to get you on that path to 20.
Next up, I'm not sure if you guys are talking to a real person or a fake person. I could be AI Benny. It could be AI Kyle. It could be AI CJ over here. Someone's got an AI avatar right now. I think maybe we're testing it out.
It's definitely not the CFO.
Yeah, you probably get some interesting lawsuits. CJ recommended that we do this accounting practice. So I have been partnering up with this company called SuperMe. And what they do is they like pull in all the things you've ever written online or like any podcast you've ever done, any session you've ever spoke at. They pulled it in together and they made an AI avatar that's even trained on my voice, which is a little creepy. And so I haven't tried this out yet. I don't know if it's like going to give us like BS, like ChatGPT style answers or actually be useful. So I thought it would be fun to use. You can use the like microphone button and we can ask it some questions and see how it responds.
Let's get funky here. What's the best compensation structure for a usage-based sales team? Please keep it to 100 words or less.
I don't know the answer to this. So I'm now very curious what AI me is going to think.
Well, I want to see if it also supplements it with stuff from outside too.
For a usage-based sales team, reps ideally have a book of business with assigned leads. Base their quota on the overall revenue within that book, whether it's from self-service or contracts. This motivates reps to grow their business each month and do what's best for the customer, reducing conflicts between sales approaches.
This seems pretty correct.
CFO approved. You heard it here first.
It's a little vague, but it's correct. How about this? What does Kyle think about CJ Gustafson? Please keep it to 100 words. Be blunt and ruthless based on my interactions.
Nope. Interesting.
Oh, man. Doesn't do community guidelines. What did you say about me, dude?
Ooh, I'm sorry. You must be trained on too many podcast recordings.
Yeah.
Some of the things we didn't release.
What's the cost to run one of these things, Kyle? I kind of want to do one for my newsletter audience now.
I have not paid anything for it. I think that they're going to monetize people that use it eventually, but currently I think it's in beta.
This is pretty sweet.
It's fun. Now, I'm very curious. There's only been one power user so far, so I have not promoted this at all, and the product is still more in beta, but there was one power user that was trying to figure out a go-to-market strategy for their startup. And I get the transcripts back of like what someone asks and what the AI answers so that I can then use that to train the AI for better answers. And this person had like a full-on this conversation probably lasted almost an hour. And so I guess someone found value out of it, hopefully, or they just talked to AI me for an hour and are going down a rabbit hole.
It's going to be really wild when somebody cites in like their equivalent of a bibliography in board slides, like, oh, I got this from the Kyle Poyar chatbot.
Yeah, I think they're actually probably at some point, I would have to imagine, going to launch this as like a Slack connect or something where you could have it just like in your company Slack instead of connecting to an external me, connect to an AI me. That'll be scary.
But I think it's also helpful for anyone who's written a lot online or even has a company that has a lot of educational materials to say, hey, go back through what I've written. Tell me about the different times that I've written about sales incentive structures, something like that. Because I've often found myself trying to say, did I already write about this like 2 years ago? Or is there a different spin that I could have on it? Or can I cite something that I wrote before?
Yeah, the same. I mean, I've now been writing. I started writing when I was in consulting. So that was like 15 years ago. And I've been writing on mostly the same topics. I mean, they've evolved over time, but pricing stuff has gone out for 15 years. And so I'm a little bit scared of what some of the archives say, but also kind of curious about it.
How many times can this guy write about net dollar retention?
The limit does not exist.
Yeah, limitless. Trick question.
I can be contrarian here. So what's the point of this? It just Googles your things you've written? Like, is it like, do you think that person that had that hour-long conversation would have been able to find the same information if they just Googled what is the best AI pricing model? Kyle Poyar.
It's a good question. I think that over time, so ChatGPT is trained on like very basic stuff that I've written. So and it's very confident that it knows me, but it'll give you kind of a confident BS answer. I think the idea here is it gets data that would otherwise probably not be fed into an LLM. It's like custom trained on this data, like only. It can also get better as I try to improve it based on what people ask. Yeah, I think in theory, this is just going to be better because it's more of a closed system. But yeah, time will tell.
Wouldn't you want to prevent it from maybe getting some of your Substack articles that are behind a paywall? Because then I could just go to the chatbot and find out that information. Like if I see there's something behind a paywall, I just want to ask the chatbot.
Kyle's cannibalizing Kyle.
Someone's got to do it.
Yeah. I'm a
So,
real startup. I disrupt myself.
yeah, yeah, exactly. Before I've even started up. That is a good question. There's an element of authorship here. I have to imagine that this is something that I think if you really cared about it enough, you could actually build your own like custom GPT trained on what I have to say. So like someone could probably build this off the shelf or like build a simulation of this off the shelf themselves. But I think that to me, the rationale is it makes the content that's already out there like much more digestible and more valuable. And if someone likes it, they're going to want to subscribe to get new stuff that's not in the LLM or get research that's like a clip deeper than what they see in some of these like AI summaries, or they'll just want to talk to me for advising purposes because they've gotten the snippets from AI, but they have like a more complicated question or they want to ask like a nuance about implementation that is not written out there. So I think of it as like kind of lead gen for everything else I do rather than cannibalization, but maybe I'm wrong.
In a startup pitch deck, you would say it makes your platform infinitely extensible, whatever that means.
Infinitely extensible. I like that. You're out here with the big terms, CJ. Can you spell that?
Yeah. Sometimes I read the dictionary before I go to bed.
Be honest. I know you're an AI avatar, but are you really a platform?
I mean, am I not a platform? So did you see this piece from A16Z, CJ, about platforms?
Yeah, I did. I have mixed feelings on it.
So for folks who haven't read it, there's always been this like kind of truism in tech that like you either die a point solution or live long enough to become a platform. A16Z was trying to take this concept of like kind of calling yourself a platform is a bit of a cliche, but they were looking at which companies are actually platforms and do they perform differently than their non-platform peers, particularly looking at public companies. But you're skeptical.
I thought they were going to say you either die a newsletter or live long enough to see yourself become a podcast like me and you. But I do tend to agree. And I think there is some survivorship bias in here too. Like if you're successful enough, chances are you're probably going to have enough cash flow and enough time to figure out what a second product is, hence making you a platform over time. And it plays out in the numbers. So they show that gross dollar retention and net dollar retention are higher for companies that we'll call platforms because you have multiple things to sell and you become stickier if you're embedded in more workflows. So I agreed with most of it. I didn't think it was like the most novel idea in the world, but yeah,
this is true. VC content after all. That's the point, is to sound smart, not be novel. For people that want to check out the report, I think some of the characteristics they use to say, hey, is someone a platform or not a platform? It's like, A, are you mission critical to customers? So this usually gross dollar retention in the 90s, average contract value on an annual basis of like 100K plus. So big deal, sticky customers. And then 2 was market leadership in your core market. And they looked at a term they called relative market share. That's essentially how big are you relative to your competitors. And they said the leaders are usually at about a 2.5x. The third was increasing returns to scale. And so looking at multi-module adoption, their benchmark was 40 to 50% of your customers are using at least 4 modules, and your net revenue retention rate is ideally, north of 120%. But like you release a lot of products, customers buy them, you can increase that NRR over time. And the final piece was expanding TAM. You might have started in a small market that you became the market leader of, but with each of your products, you keep expanding the addressable market for what you're doing.
Well, speaking of big words, have you heard of the Herfindahl Hirschman index?
I feel like you just made that up. What is this?
No, Ben, pull it up. The HHI index. It's a measure of your relative market share within whatever sector you compete within. And so the highest you can score on it is 10,000. The lowest you can score is 1,000. On the low end of the spectrum, 1,000 would mean it's highly fragmented. There are a lot of players there and you don't have a lot of market share. And the other end of the spectrum, if it was condensed among just you, monopoly, or it's an oligopoly, the highest you can score is 10,000. And so it's this mathematical formula to measure how much market share you have relative to the other players.
You're blinding me with your brilliance, CJ.
I once calculated it using Gartner numbers and Forrester numbers for countries that we were thinking about going into when I was at this backup and recovery software firm, because not every player like say IBM or Commvault didn't have the same market share in, say, Asia. So it was like, where should we deploy our resources to go after it? Because we went from single to multi-product. And then as a part of that journey, it was also, how do you go multi-international?
The sequencing is tough, right? As you debate like multi-product versus multi-geo, or are you trying to do both at the same time? And it's a complex math equation. But yeah, I think going back to this piece, what I found fascinating about it was that it actually provided like specific metrics and then benchmarks for what companies might be platforms and not, as opposed to just, hey, we're a platform because we're calling ourselves a platform. Now, I don't know if I agree with all the metrics they chose and the benchmarks. And these are like very specific to large at scale public companies, but it's at least a helpful starting point. I think these are the right kinds of areas to look at. And then in theory, these platforms that are market leaders in a niche and then can expand that platform opportunity. Like in theory, these companies trade at really significant premiums and they can keep expanding their valuations over time as they, never churn out their core customers and are successful at continuing to upsell them. And so the returns for the platform companies in their data set was about 163% versus non-platforms was 32%. So it clearly speaks to that upside if you can be that dominant platform in your space.
And they did reference CrowdStrike and Datadog, both of which have two of the most beautiful slides in their Investor Day presentations. It's the multi-product attach. So it's customers on 6 or more products, customers on 7 or more, 8 or more products. And now that they have 20 products each, it becomes easier to attach more products over time. But what's interesting is once you get a customer to say 70% or more of your customers on 3+ products, you actually want to roll that stat off because it becomes diminishing returns and harder to get that last 20 or 30% on. So you'll see in the decks now, it starts at 6 or more products and goes up to 12 or more products.
So it shows oh yeah, we're at 10% or at 6 or more, and we got that up to 15 or 20%. Yeah, but the 3 or more number is staying the same. The company that I always think of as the poster child here is actually Veeva. I feel like they're the OG at doing this.
Life sciences, right?
Yeah, I think they started as a CRM for life sciences, and now they have world's largest number of products. And what I looked at one point, I was kind of fascinated with this idea of how to tell if a company's product led. And one of the metrics I looked at was the ratio of their spend on R&D versus sales and marketing, with the idea that if you're actually a product-led growth company, your growth comes from investing in the product as opposed to just investing in sales and marketing. And one of the companies with the lowest ratios was DocuSign, which is a company that people think of as product-led, but really much more of a sales and marketing machine. And then one of the companies with the highest ratios was Veeva, because they've locked in all their core customers, and now they just keep building new products to upsell folks over time.
There's something to be said too about being a core system of record, right? A lot of data gravity. They have the sales data in there. They may even have some financial data in there. Same thing with a Workday becoming a platform for your HR data, your financial data, and for your forecasting. So I think a lot of the products in here were either critical infrastructure, Kyle, or they were core systems of record.
Yeah, and I think that we're going to have to see in the AI era, what does it actually mean to become a platform? I think both AI is making it easy to start to take some market share from these platform companies, because you can find an area where they're bad and, build an AI native opportunity there. But those wedges might not be as sticky as that, system of record wedge was for the vertical SaaS companies.
Oh, so true. And I was interviewing the head of marketing at NetSuite, and I said, do you think implementation times will actually go down with AI? Because that's always been a headache, right? With these core systems of record, that it takes a lot to move from one to the other. And he said, actually, I think that it's going to help a ton with the onboarding, because you can take these data sets and say, move it from one GL structure to another. So to your point, Kyle, I think that'll be fascinating on how AI makes it I think it'll make it easier to switch, but we'll see.
Next up, we've got Benny's favorite. It's business blunders.
So I have a business blunder myself before we get to this one here. So Kyle, did you see that Navan IPO'd last week?
I did, which we talked about earlier on this podcast. And then you wrote a really great piece about their roadshow, and even getting into what snacks people were eating on their roadshow and all that.
Yeah, their president, Michael, he loves Sour Patch Kids. Amy, apparently, their CFO, subsisted on air and like pecans or something. So different meals along the roadshow. But it was kind of cool. Like their IR team, their comms team called me up and they're like, I guess I'm a news outlet now. They're like, hey, do you want to talk to them like a couple hours before they go public? I'm like, sure. So not really knowing what to do, I got on the phone with them. I, asked them the questions that I was curious about how you even prepare for an IPO and more specifically what a roadshow is like. And I did this write up. I felt good about it. I timed it to go out at 7:22 Eastern, which I do with all my posts. And I went to bed. And so I was in San Francisco and I woke up in the morning, probably like 8:30 Eastern time, to like a dozen missed calls from their PR team and a couple voicemail.
So
Walter Cronkite over here, breaking the news.
They were really thrilled with what you did, huh?
I'm like, wow, this piece must have went viral. They must be like so happy with me. And so I called them up like bleary-eyed. And apparently there's something called, do you know what an embargo is, Kyle?
I mean, I worked in marketing, so I do know what embargo was, but do you know what an embargo is probably the better question.
I thought it was like a French restaurant or something. So
They're
apparently
close. I mean, you've got escargot, so not that far
I'm
off.
like, nobody invited me to the happy hour. I didn't know what that meant in the email. So I'm like, I'm just going to let this ever fly. And apparently on the day of their IPO, I released it like earlier than every other outlet. So, the early bird gets the worm.
You can't unsend an email.
That's what I probably should have said on the call. Like, I'm sorry, I can't put the toothpaste back in the tube. I hope you like the piece though.
You can't, but, yours was by accident, right? I think that there was another business blunder that went viral this week with a CRO actually kind of breaking their own confidentiality.
So this one made me feel so much better about myself, Kyle. It was actually the next day. So the CRO, the person who heads up sales at Snowflake, he's walking through, I think it was in Times Square or downtown San Francisco, but either way, this YouTuber comes up. And so this guy basically goes up to him with his phone, and it's reminiscent of those things like, sir, you're driving a nice car. What do you do for a living? Like those type of YouTube shorts. But he starts asking the guy about what his position is, where he works, blah, blah, blah. And then the guy, for some reason, he adds in, and we'll do 4.5 billion in revenue this year. And by 2030 or whatever, we'll do 10 billion in revenue. And so mind you, this is a publicly traded company, okay? Market cap over $50 billion. He just gave forward revenue guidance to like this 18-year-old YouTuber kid. And so it starts going viral because the official guidance the company gave for the year was only 4.4 billion. And then even worse, he basically gave the out year guidance for multiple years after. So this is a public exec at Snowflake, and he basically gave this YouTuber the internal financial forecast for Snowflake.
Also, like, no one should ever trust a CROs for revenue guidance, especially should not trust it when it's at a publicly traded company. That is just so funny. I can only imagine the conversations he must have had internally afterwards.
Yeah, that was a tough interview to give. So I feel a little bit better about mine. Sorry, Navan.
Next up, we've got pricing in the real world. Take it away, CJ.
CJ, why were you texting me about snowplows and snow removal at 7 a.m. this morning?
Because I know that you love pricing, Kyle, and me and my wife were debating. I'm lazy. I don't want to do it myself. I don't even have a big driveway. But she said, I know you're going to be useless when there is snow, if there's snow this winter. And so she was pitching me on this company who can come and basically, like, if it snows, we will do whatever we do. We will plow it. That's what they were going to do. And I was like, well, how much should this be? And so I started going down this rabbit hole on how you price a business like this. Most of them just charge you a fixed dollar amount for the season. And this is for residential. There are more complicated commercial arrangements you can get into. But basically, I'm signing up to pay $900 to $1,200 no matter if we get any snow or not. And so I just thought it was a unique way to do this because I feel like they, Kyle, actually have more information symmetry than I do on this. And so they probably backed into like, how much would we want to plow this guy's driveway and how much would we make off of it? But what happens if it's like the blizzard of 72 or something?
Yeah, this is like classic insurance pricing, right? Like if you were to look at the per plow cost of that, it probably like never justifies itself except for in the extreme years, but then it feels reasonable and it's like, well, you just have someone that's going to guarantee solving this for you. You're not going to have to think about it. They're going to, locking in the plow, even if it's like a crazy blizzard. I actually don't do the per season pricing anymore. I just pay as you go. And in Boston, most years, that's fine. But we did get one year, like 10 years ago, and we got like over 100 inches of snow, and it would not have worked out well for me that season. I remember plowing my sidewalk that year, and the people plowing their cars, they would put their snow onto the sidewalk. I would take the snow, put it back on the cars, and it was like at some points over my head high. And so it would not have worked out well that year, but honestly, every other year it would have been fine.
So I caved. I just locked in the peace of mind. I'm like, it is what it is. If it snows, it snows.
If it snows, it snows.
The snow removal I pay for is the taxes that I pay to live in California. So
Ben's wearing flip-flops and sandals today. I saw him stand up.
quick, blur this. Don't let anyone get this for free.
Mostly Growth is a Mostly Media production. Executive produced by Ben Hillman. That's me. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of CJ, Kyle, and Ben. Just some guys who love talking growth. Mostly. If you like this podcast, hit subscribe. Give us 5 stars or hit like. The algorithm overlords thank you. Drink water, call your mom, and have a great day.